Hello everyone, welcome back to another portfolio update. In this video I want to go over what I'm going to start contributing to this account in order to get the best results from compounding interest. But before we get into all that, let's look at the portfolio. I think I'm probably going to start recording these on Sunday and maybe uploading them on Sunday too, just because I have a little bit more free time than any other day of the week. But so far, we're currently sitting at $3,182.56. My position has increased in a lot of these. I think I've bought more of the Schwab's US large cap growth ETF. So my percentage is at almost 31%. I think I've increased my positions in MasterCard and Visa and Vici from the last time. And so far, I'm up 2%. You'll only start seeing new positions when I feel like I'm buying them at a good price, a fair price. The last thing I want to do is buy overvalued. So that's currently why I have Visa, Vici, MasterCard, Canadian Pacific right now. And I do want to add more holdings, but a lot of the holdings I'm looking at right now, they're just not where not where I want them to be. I think a lot of them are pretty overpriced. So with the money that's coming in, probably a lot more of it's going to go into the ETF and MasterCard and Vici and Visa and Canadian Pacific if I think they're still at a pretty good valuation. But that's currently what I have right now. I believe that the quicker and earlier you start contributing into the market, no matter what the market is looking like at the time, the better results you're going to get. One major problem most people have when trying to do this on a consistent basis is that they're always concerned about what the market is looking like at the time. And when the market starts rising, they're scared that it's too expensive to get into. And when the market starts dropping, they're scared that it's too bearish and that we're heading into a multi-year bear market. My plan is to not focus on the noise. All the little things that are making the stocks temporarily drop in price is not what I'm concerned in. In fact, I'm going to see those as buying opportunities, and I'm going to end up buying more. I'm not interested in what the market is going to do in a week, in a day, in a month from now. My goal is to always be buying, and if at the time I don't see a good buying opportunity to add to new positions or to certain positions, I'm simply going to add to my core position. I'm going to try not to hold on to too much cash. My goal is to have my money working at all times, and I'll be doing that by buying high-quality companies, simply because I believe in the saying that time in the market beats timing the market. Usually when I see YouTubers showcasing their portfolios, a lot of them have so many positions, and on top of that, a lot of bad positions. I see a lot of showcasing trading accounts with bad returns compared to the S&P, and most of them having no returns. A lot of them actually losing money, ultimately not truly showing the power of compounding, and my goal is to show that here. I'm going to keep it simple and show that anyone can do it with a little common sense and research, and that you don't have to get complicated. I'm not going to be doing options, and I'm not going to be doing trading. I'm also not going to be selling contracts or using leverage. I'm simply going to be buying high quality compounders with hard-earned money. I'm also not going to be speculating. I'm simply not gambling. If a company doesn't have the financials and a good story, I'm not investing. I don't believe in buying the rumor, so the news. If the company isn't bringing value back to the investor, it's not going in my radar. So let's get to the title of the video. I'm going to be investing around $600 a week. Sometimes it's going to be less, sometimes it's going to be more. And at the end of the month, I'm going to add whatever's left I managed to save that month. On average, is probably going to average around $600, and so about half of that's going to go to my core ETF position, and the other half is going to go to my individual company picks. I also think that showing this to you guys is going to be entertaining and educational. As time goes, I'm going to keep trying to improve as an investor and consistently be learning more and improving my research. I want to have a strong conviction in the companies I choose to invest in. I think one problem most people have when picking companies is that as soon as a company starts dropping in price, their belief goes out the window. Even if there's nothing fundamentally wrong with the company, And then there's those who are the opposite, who are so stubborn. They'll hold on to a dying company that has no proof of making a recovery. For example, I've recently watched a few portfolio updates of people buying Walgreens. And recently Walgreens came out that it will be closing around 8,600 stores. And people are buying it up, hoping that it's going to make a recovery. Walgreens' price in the last year has gone down around 59%, with margins lowering on top of that. Walgreens has no competitive edge, and it has no moat. There's no reason Walgreens is going to stand out from all these competitors, especially when companies like Amazon and Walmart exist. In the past 10 years, Walgreens' free cash flow has gone down an average of 25% a year. That's money that companies use to buy back shares that increases your equity in the company and pays investors dividend. Another red flag is that the company cut their dividends to about half. Overall, people that are buying into Walgreens are speculating that the stock will make a comeback, and I don't think that'll be the case. Instead, those same people could be putting that money into a quality company with real good fundamentals that provides value to its customers and investors instead of a bet. This is where we go back to having a little common sense and doing a little research. From me today, hope you guys enjoyed the video, and thanks for watching.